really, when we look at the news, it's important to sort of look at it in context. Whilst we had quite a reasonable rally, a lot of that was very much sort of profit taking, and it's something to bear in mind as you come towards an end of a week, or the beginning of a new week. Always look at what we've had before. So if you come to the end of a week and you've had a big period of down, deeper and down, or whatever the song was, you could always end up with a little bounce on a Friday. Not because people are buying it, but because people are taking profits and they're closing their shorts, if you know what I mean. They're still buying it, obviously, but they're not looking to go long. They're looking to close their short trades and looking to take their profits. So always consider Friday in context. If you had a big, strong week in one direction, consider the profit taking and consider potential change in direction there. So the effect on the US dollar, commodity and bonds is less pronounced as we've seen little recovery in the euro dollar, although it did bounce to 128.20, but then has really very much fallen back there. Core bonds, really remain very strong, underlining perhaps the temporary relief in the markets may be experiencing. But, as far as data-wise is concerned, we're only a couple of days into the trading week, so not much data releases to report, especially bearing in mind that there was no data to speak of on Monday. The most notable news, I suppose, was really the UK's inflation data, which saw CPI drop to 3.0%, 3% year on year, against expectations of 3.1, and considerably better than the 3.5% posted back in April there. So that was really the big bit of info yesterday. And if I move through to sterling dollar, we can really get an idea of what happened there. Potential short trade at 9:30, you'd be a little bit bonkers to take that trade, of course, because it's right on the data. Yes, you'd have ended up doing rather nicely. And we were sitting there waiting for a short. In fact, I was online with Malcolm right at the time, and he was saying, should I be taking, well, Malcolm's not in here, should I be taking a short here? It looked good, but obviously data, and really the market moves so fast, so quickly, it's quite difficult to get on it. I know he took a few pips out of it, though, nonetheless. But why did GBP react to the way that it did? Well, this is something that not all of you may be aware, but when it comes to quantitative easing, which really is the talking point in terms of how the Bank of England can help the economy, more recently the MPC has been in two minds about adding to quantitative easing, partly due to the stubbornly high inflation rate. Therefore, a lower than expected inflation reading yesterday could, in theory, increase the chance of further QE when the MPC meets. And QE has the effect of weakening the currency, notwithstanding the effects from other factors that may offset this. So the weakening currency, and that's why we've seen that greater chance of QE, greater chance perhaps of cutting interest rates, making sterling less attractive to investors as well. So that's really the sort of suggestion that came yesterday from the IMF as well. Released its review of the UK, the IMF did yesterday, and its efforts to manage its economy and pile of debt. The main thrust from the report was that the UK could cut rates. We're already at 0.5%. I mean, what are you going to do? Cut it to zero? Cut it to minus numbers, possibly? It's been done before. It's been done in, I think, Sweden, I think. So, you actually having to, you're being charged for having your money on deposit. Outrageous. But, potentially QE being resumed, and that's hence the reason for that sort of heavy sell-off that we had there on sterling dollar there. So big falls, lower highs, lower lows, and as traders, we don't really mind as long as those trades continue to kick in and give us nice trading opportunities there. The other news that really hit the wires was the Fitch downgrade of Japan's credit rating. The credit rating agency citing the rapid deterioration in public finances in the world's most indebted nation. So why is Japan not a Greece? The answer is that is not reliant on many external investors to finance its public debt. This mostly comes from within Japan, hence the reason why Japanese bonds remain relatively strong. So there we go. That's really what's going on news-wise at the moment.